When the going is good, you also must understand that things can change. Preparing for the change is very critical. What kind of preparation you need to do? Are you positioned correctly for the emerging scenario? Do you need to do something specific? To understand these things, do join us on this webinar and participate in it to prepare yourself better for your tomorrow in investing. Thank you very much. Friends, in this video for ithought Advisor, I am going to talk to you on the topic expect less, invest more. You will be surprised I am asking you to expect less and at the same time invest more. Yes, in a year when the economy is going to be challenged by inflation, by global flows, by changing thematic preferences, it is important that you set your expectations correctly. If you are going to expect very high performance, then you are going to be disappointed. And what do you do when you are disappointed? You fail to invest exactly when valuations are attractive. So, if you must use opportunities that come your way in economic circumstances which are temporary and which are challenging, you must set your expectations correctly. Importantly, you must expect less. So, by expecting less, when you see bad news, you are better conditioned to consider investing some money into your portfolio. You will not be sitting and watching. Instead, you will see where can I make an incremental investment. So, having lower expectation prepares you to invest more. In a year like this, when we will see high inflation, we will see interest rates going up, we will see liquidity coming down, we will see global flows changing rapidly. These changes will lead to a softer stock market. This means that you will not see the kind of performance you saw in the previous 2 years. Effectively, valuations of companies may come down even if their performance is improving. If a company's performance itself is not showing such a great improvement, the valuation may come down even more. Some of the companies you always wanted to own may be in that list where the valuations were always high, but now near-term underperformance in the business is reflecting all the more in the stock market. When that happens, if you had set your expectations very low, you will be inclined to use that dip in stock valuation to invest more money into a company which you always wanted to own. Effectively, you will end up owning more in businesses which you always wanted to own because you set your expectations correctly and you were willing to invest more if there was a sharp contraction in the valuations. Doing the right thing is the most critical factor in improving your returns. If you want to get better returns out of your portfolio, it is important that when opportunity presents itself before you, you do the right thing. This year will give you a lot of opportunity to do the right thing. It's not a year where you will put your money into some place because you couldn't find a better place. Instead, this will be a year when you can put your money exactly where it will give you the best performance because valuations will moderate and you will get such opportunities. Remember, last year you may have been more than willing to invest money, but you didn't get those opportunities which would take you to a better place. This year, you will get those opportunities that can potentially take you to a much better place. The important thing for you to understand and follow in your investing is to set reasonable, soft expectations from your existing portfolio, understanding fully well that when this phase of underperformance in your portfolio plays out, you should be chasing investments which will bring performance back to your portfolio when economic circumstances improve, when inflation moderates, when interest rates stop rising and gradually start falling, and when liquidity once again improves. This essentially is what every investor needs to do in this year. Expect less, invest more. Your journey to a better place has just begun. Thank you for watching this video.